Greetings, folks. John Grace, President, Investors Advantage, and the Money Doctor is in. Now, our topic today is markets love faking out investors. And I'm holding this glass to represent the Kool-Aid that the government wants you to smoke, if not drink, okay? And I'm going to suggest that you not drink the Kool-Aid. It's bad stuff. It's hazardous to your health. It's certainly hazardous to your wealth. And we want to distinguish between some of the things that we are led to believe versus what's really going on around here. We've got some real headwinds, whether it's Germany and their demographic cliff, whether it happens to be Russia behind Malaysia Airlines 17, or looking at the uneasiness that's happening around the Middle East today. These are uncertain times. They are indeed dangerous times. And we would suggest that these times are neither normal nor are they the best of times. So we want to see what's happening so we can make some informed decisions. No one has a crystal ball in terms of the future, but we want to read what's going on with the economy today so we might make some fundamentally strong decisions. When we look at the real estate market on the way to recovery, the stock market hitting new highs throughout the last 5 years for sure, up 192%. We can see that happening, and many of us feel a sense of complacency. We're going to suggest don't become complacent. The markets seem to have put all of the bad news, all of the reality, this is not Disneyland, on ignore and hitting new highs. And a lot of people are getting in. They may not be getting in at the very best of times. We've got margin debt for investors higher than we saw back in '07, higher than we saw back before the tech wreck of 2000. We look at bubbles. They always burst 100% of the time. Doesn't matter if you understand what causes the bubbles. Doesn't matter if you can explain why the bubble is happening. But when we look at bubbles, and we've studied these things, including the tulip bubbles to begin back in the 1600s, we see that on average bubbles not only burst, they revert back to where prices started going up, and they come down from their peak on average 70 to 90%. Keep that in mind. You saw an 80% decline with the NASDAQ, the tech bubble, back in 2000 to 2002. You witnessed that. Could it be happening again? I don't know, but there are some disturbing signs about what's going on. Let's look at what the average investor does, or the average person in America. Do not pay attention to your friends, your neighbors, your relatives, the people on the coast. Let's look at Ohio. Let's look at the average person. That would be Homer Simpson. The average person in America gets their first job at age 20. And then we buy a house. And then we buy our biggest house, typically late 30s, early 40s. The majority of people hitting late 30s, early 40s peaked in the year 2000. The biggest house typically is bought and paid for, financed at age 46. That peak occurred in 2007. This year we're at another peak, 53. 53 is the age at which most people stop spending altogether, even the well-heeled, unlike they've done before. So we look at the boomers, drove the economies, 1946 to 1964. We see Michelle would be age 50 today. George W. Bush is age 68. Let's add 10, 20 years. What do you see their spending's going to look like, in your opinion? You be the sole judge. Outside of healthcare, do you see increased spending? Wherever prices might be, wherever interest rates might be placed, do you see increased spending? Tapering will be gone away probably in October 2014, just at the time that peak spending stops occurring. Now, when we look at the very well-heeled, we want to look at two groups. We want to look at the top 20%. They control about 50% of all spending in the country. And the top 1% controls about 20% of all spending in the country. And on top of that, they hold about 50% of all the wealth in the country. So Homer is very important. The top 20% is very important. The top 1% is very important. All in decline. The Fed is doing everything in its power, along with other governments around the country, to pull out all the stops, to make you spend. But we're going to suggest that human behavior, just looking at the patterns that we're all in going through life, is going to be in the face of that. It's going to be a huge win. I like what Michael Cox had to say when I had the pleasure of meeting him. He was formerly with the Chief Executive Officer for the Federal Reserve Bank of Dallas. He said, buy and hold is no longer always good for capital gains. Investors may need to buy and sell to get ahead, or hire someone to get the job done for them. He went on to say, unlike the last 25 years, the road ahead could be a very bumpy ride, to which I agree 100%. So these are my 3 assignments for you, my prescriptions from the Money Doctor. 1, don't drink the Kool-Aid. Number 2, make sure that you explore other asset classes that might be new to you. but other than what you've held over the last 25 or 30 years. You might go on a little exploration project to learn about some things that maybe you didn't see before. In fact, look at some of the things the endowments have been doing. And third, this would be the time to put strategies in place where there is risk on and risk off. Where can you put strategies in place that takes money off the table or off that market in a bad year and back on the table in risky assets in a good year? With that, the Money Doctor is out.